Welcome to the weekly video update, where I'll go over the action in the market for the week of October 9th through the 13th, and then we'll see how things look for the week of October 16th through the 20th. Now, believe it or not, we actually had an up week for the S&P. It was mixed across the board. We had some new geopolitical events come into the picture that developed a week ago, and we're dealing with a lot of variables and uncertainties right now, and the market's not quite sure how to handle that. It really was quite resilient in the face of what's happening in the Middle East, specifically in Israel. But this is seen as a flight to quality, which means they're taking money and going to bonds. And when they buy bonds, that pushes interest rates down. And the interest rates going down gave some support to stocks to go up. And we also saw oil fall from where it has been recently. And that's also been giving some support to stocks. Before I get started, please know that there's a PDF that's available in the description below each video that I post. Not only this weekly video, but all of the daily videos as well. The pivot points for each day are posted on the community tab on the YouTube channel. I can't really do that on Rumble. I can only do that on YouTube. I do have a private Facebook group that you're welcome to join. It's not really active. I pretty much am the only one that posts there. But if you want to come and join and have some back and forth, we can certainly do that. I will be posting a new poll after I get done with this video. And I keep a real close eye on YouTube comments. Again, I had to go back this week and delete a bunch of comments. I want the garbage and crap comments gone. If you want to voice something, you're more than welcome to do that. In fact, I expect that and kind of hope for that. Even if you disagree or reach some different conclusions than what I've been reaching, that's fine. It's the garbage stuff that's more scammy in nature. And so, in fact, I had to go into Rumble and delete some comments there. I've been getting some garbage ones there as well. I do post also on Rumble, and here is the link to the channel if you should ever have need of going there to find the videos. Let's go back and talk about this week's session. For the week, we were up 0.46%. Not very much, but we were up last week as well. So it's helping some of our weekly charts to look a little bit better. We did have below average volume. Now, last week we were above average, but in the week that we just ended with, we slipped back down to below average volume. And we saw that pretty much each day. The only day that was above average volume was Thursday, and that's when CPI came out. Our technicals were negative, but we're looking a little bit more positive. There's some positive and negative things that we can take away from the charts. We're pretty much at an inflection point on the daily charts where we could break higher from here and justify that. In fact, we're still leaning more towards the positive side, but at the same time, we're coming into some weaker seasonality for the month of October, where on a historical basis, we tend to see some weakness around this time going into the end of the month. And so the market may pick up on that, or it can kind of split the difference between the two and not really go up, not really go down, and just chop more or less sideways. We're seeing some of our trend indicators start to get back down below 20, suggesting that we're not in a real trending environment. And I'll show you the weekly chart of the ADX coming up here. Right now, it's about what's happening in Israel, but that bleeds through into inflation and interest rates, growth concerns, what the Fed may say, what the Fed will ultimately do. Our trend is a weakening trend. We still have the ADX going below the moving average. The red line's on top, so it's still a negative trend where we're pretty much right on top of each other in the daily charts. So for the week, the Dow was up 0.8%. That's the blue chip stocks. The NASDAQ was down 0.2%. The S&P was up 0.4%. And the small caps, they're still really struggling. They were down 1.5%. So some of the bullet points to what happened. Israel did declare war on Hamas. Now, you're probably already aware of that. I'm just trying to bring this up as it applies to the market. This was a surprise attack. In fact, in last weekend's videos, I really didn't mention it because I was too busy preparing the videos and I didn't know what was going on. So it was later that I had to pick up with what was actually happening. The thing that we're watching for now is, will this escalate? It's between Hamas and Israel. Well, Hezbollah's kind of gotten involved, and they're in the northern part of Israel. Iran backs both Hezbollah in the north and Hamas in the south. Okay, they might get involved. Iran and Russia are starting to team up and do things. Russia's at war against Ukraine. Is that going to escalate things? Not saying that that's what will happen, but we're just waiting to see how things will actually play out. How much will the U.S. get involved in this whole thing? Right off the bat, it seemed like most of the media was really in Israel's favor and seeing them more as the victim. But now, like we usually see when it comes with Israel, that's starting to turn. And we're starting to lecture Israel as to what they should do instead of saying, no, you guys need to do what you feel you need to do. Okay, it's like some other country telling us what we need to do in the U.S. It's like we wouldn't stand for that. Why should Israel? Okay, that's just where I come out on this. Interest rates did decline, and that gave support to stocks, especially earlier in the week. And that's why people were saying, well, we got this whole thing going on in Israel. How come the market's going up? It's because interest rates were going down, and we were oversold at that time. The current scenario, and this is taken word for word from what I say in the daily video, the idea is, and we've been doing this for about a month and a half now, this is the scenario that we're playing out here, is that the economy is stronger than expected and that the Fed will, at the minimum, have to keep rates higher for longer. If we keep having some stronger than expected economic reports, they may have to raise rates. Now, it doesn't look that way right now, but that could always change. We're also keeping an eye on the weakening economy in China. They're trying to stimulate things there to get some growth going. We're keeping an eye on what's happening in Israel, and we're also keeping an eye on oil prices. Oil did climb for the week. It was back up to 87.80, where week and a half ago, it got up into the 90s before this whole thing started. Earnings that were released were starting to come into that season now. They were taken as positive. We had some big banks earnings that came out, like JP Morgan, Chase, Wells Fargo, and Citigroup. We also had another influential company, United Health Group, came out with their earnings. Taken together, they were seen as positive. And the House still doesn't have a speaker. Steve Scalise, if you remember him, he's the guy that got shot when they were playing that football game, when the guy came out there and tried to wipe everybody out. Well, he's also dealing with cancer, from what I understand, and he just was not able to get enough support. Jim Jordan is kind of the next name that seems to be running right now, but we'll have to see if he can get any support. And we don't know how long this is going to go on. So this is producing some uncertainty and some instability in the government in the U.S., and that can sometimes lead to some nervous times. We're keeping an eye on the VIX, where right now, and I haven't been updating this chart is kind of old now, where we're coming up to the top part. That's the middle of October, and that's the time that we're coming into now, where historically we usually top out with the VIX and then start to come down. The VIX goes up when stocks are going down. The VIX goes down when stocks are going up. Again, we have some seasonality that goes against this, but this is one thing that could end up being used as a guide to see where we go from here. Also, we're keeping an eye on inflation. We did get CPI this past week, where we're still in this sweet spot now where we tend to see inflation really trailing off. But as I always point out, what happened right after that? At least if you go back into the 70s, the blue line really shot up. But the market's not really fixated that far out into the future. We're just kind of taking it one day at a time and one quarter at a time. We're also keeping an eye on the 10-year yield, where it closed on Friday at 4.63%. That's above the 4.02%, where this research suggests that that's when earnings for companies can start to run into trouble. Getting into our poll results, and yes, I have this kind of different. I asked 5 questions instead of 4, so we're going to come up a little different here. Last Friday, we had a pretty strong day, and of course, I had to have my obligatory typo here. There are some positive things, and again, you have to look back a week ago, that are building under the surface. Do you feel that these positive things will lead to an advance or a continued decline? 40% thought that we would go up from here. Well, we did, but not by very much. Nobody thought we would decline, and most 60% thought that we would lead to choppiness with no real direction. And that's kind of where we ended up by the end of the week. We're right at some solid support on a number of different charts, where we could go higher from here, we could go lower from here. The market is really indecisive. Okay, now zipping up to the upper left-hand corner, small and mid-cap stocks have been under a lot of pressure, especially when you look at them. They're underneath their 200-day moving averages, and they've been there for quite a while, and they're giving right now they're still working off of a golden cross. Do you think that this will lead to a death cross? And we were split across the board, 50-50, thinking that the golden cross will remain, where a death cross will be generated. We're also split on our charts. With the small cap index that we follow put out by S&P, we've already generated a death cross. With the Russell 2000 small cap index, we haven't generated a death cross, at least yet. Then, do you feel that the stock market will follow the usual seasonal pattern that typically sees a bounce into the middle part of October and then a decline into the end of October? Or do you think we'll keep declining without any kind of a significant bounce? Or do you think that we'll just throw all of that out the window and continue with an uptrend? 50% said that we'll bounce until mid-October and then decline. 38% said that we will continue a decline without a bounce. And 13% said that we will have a new uptrend. And so far, it's still undecided at this point. And then over here on the right, over the weekend, now I talked about this because I was a little late getting the questions posted here. War has broken out between Israel and Hamas. Do you feel that this will impact the markets or have no impact? And we were split 50-50 there. Then the last question, oil, interest rates, and the dollar have been pulling back after really moving up. Do you feel this will continue after a pause, or that a trend will start to go down? 75% said that there'll be a pause before resuming an uptrend. 25% thought that we'll be beginning a new downtrend. Okay, there's the poll results. Looking at some Isabel Net blog charts, I show this just because I have the red arrow on here, and this is why the stock market justifies itself by going higher. When you look out, whether it's Morgan Stanley or the consensus, we're seeing across the board increases with the earnings estimates, and that is justifying higher stock prices. Looking at the flexible price on the CPI that came out, that's the blue line, and this thing can gyrate all over the place. The one that folks tend to focus on is the red line. That's called sticky CPI inflation, and that is coming down. And these are things that don't change as fast, where a lot of other things, they could be massively priced differently day by day. But so I mainly follow the red line here, and it is continuing to decline. Looking at the credit card rate, okay, a lot of people are having to live off their credit card right now and soaking up a lot more debt because their savings are depleted and prices are going up and wages aren't necessarily following that. Right now, as of this reading here, the average credit card rate is 21.2%. My gosh, that's like mafia rates. Okay, looking at FactSet, they had one blog post. We're starting to come into earnings season. The headline here says that the S&P will likely report year-over-year earnings growth for the first time since the third quarter of 2022. We look over here on the right-hand side, and it's still negative, but it's coming in a little bit better than what they thought it was going to. Here's another chart when you project it out over the 5-year period, where it is continuing to show some growth. And again, this could be more healthy for the stock market. Looking at our charts, here's an intraday chart going back to Monday, where we bounced off of this pivot level, and we were having a little bit of trouble with the August 2022 high. Well, we were able to break through that in Monday's session. You notice how it acted as resistance in last Friday's session? Well, then we got above this, and it was looking a lot more positive until we got into Thursday, and then we saw some middle-of-the-day selling as we were coming down lower. We came right down to the August 2022 high, which acted as support. Then on Friday, we had a higher open, but then we kept bouncing along this August 2022 high here, and we closed just a little bit above that. So for right now, support is holding. You can also see on the bottom, and I have to readjust this every day, where we have the 200-day simple moving average also plotted on this chart. So for the week, we had the Dow that was up, the NYSE was up. Now this goes just the 5 trading days. So yes, we were up Friday to Friday with the S&P, but over the 5 trading days, the S&P was actually down, as were all of the other indexes, with the small caps leading things lower. And that is not positive. That's actually a negative for the market. Going back to the beginning of the year, we have all of the indexes that are positive, with the NASDAQ 100, the NASDAQ and the S&P doing the best. We have small caps that are back down to being negative going back to the beginning of 2023. Going back to the all-time high, all of the indexes are continuing to be lower. We're seeing a lot of improvement in the NASDAQ 100. It was in last place for a long time. Well, now it's being replaced by small caps. Looking at different sectors, this goes from Friday to Friday. So we had the energy sector that was up, utilities, and real estate. These are some areas that have been under a lot of pressure. Some of the areas that were down are materials, and then discretionaries having some problems lately. That's one of our growth versus value areas, and we're seeing that not really performing as well right now. It's not falling apart, but it's not really doing well, as we're seeing under the surface with some other measures that we look at. Here's our relative rotation graph, where what's doing the best is energy. That's XLE, and that's green, and that's the strongest area right now. Some of the other areas like communication, tech, and discretionary, these have been stronger in 2023, but lately they've been showing some weakness. The weakest of the week right now are the staples, and they're just having a really difficult time, where the other areas of the market are showing some improvement. They're blue and trying to move up, but they're not really positive, at least yet. Looking at the sectors for the week, we had utilities, which had a really bad week last week. Now, I mean that a week ago. Well, this week that just ended, they were up, followed by energy and real estate. These are three of the weaker areas. The areas that were weak this past week were discretionary, communication. These are areas that have been stronger so far in the year. Tech was also down slightly. And when we go back to the beginning of the year, we have communication, tech, and discretionary positive. All of the other sectors are negative. Going back to the all-time high, energy is positive, followed by tech, industrials, and healthcare, where the rest of the sectors are still negative, with real estate being down the most. Keeping an eye on sentiment, we came in Friday at a reading of 29. So looking at this historically, we did drop down below 25, and that usually signals an extreme negative reading. We started to bounce up out of that as the market was doing better. But then we ran into some problems on Thursday and Friday, and so we saw sentiment ticking back down. It's still negative. Looking at the active asset managers, after giving us an extreme negative reading, they're starting to show some improvement. So we use this like a contrary indicator. We're still working off of this extreme negative reading. Here's another look at that same chart. We came in at 45.8. We did drop down below the 40 level. Looking at the VIX, where it's continuing to go up with the line chart and the bar chart, but we're still below 20. So if you use static numbers, 12 to the low side and 20 to the upside, we're still below that level, but we've been under that level for a long time now, and we're seeing a longer-term shift in the VIX, and so it may be going down to a lower range. Looking at the Ulcer Index, showed a little bit of an increase in fear. We're coming above the moving average, showing that fear is increasing slightly. The right X bear bull ratio. Now, this only goes as of Thursday, and we're really seeing a lot of people piling into the bullish type funds. That's when this really goes down. There's not a lot of fear, at least that's registered in this chart, but that doesn't really take Friday's session into consideration. Looking at the latest reading of the American Association of Individual Investors, they're a little bit negative right now and a little bit positive. The moving average is still under zero, where we're slightly above zero based on their raw score. This is still showing that the market's hanging in there. When this black line is going down, that's actually positive for the market. That means that the tech sector is outperforming cash. When we shot up in 2022 and the black line was going up, that's when we were running into problems. Now that it's still back down here, it shows that for right now, things are still hanging in there okay. Keeping an eye on the economy, we still have a latest reading of the GDP now comes in a little bit over 5%. And that's a pretty healthy estimate for right now. Not necessarily realistic, but that's what they're coming up with. When we look at the different forecasts, we're just under 4% to the upside and about 1.5% to the downside. This is what it looks like on a bar chart with the GDP now, where we're a little bit up over 5%. Looking at the spread between risky and not as risky bonds, we did tick up just a little bit, but if the market was getting ready to really fall apart, we would see a real spike up here like we did back in the year 2000 when we saw in the COVID plunge. And anytime we really ran into some difficult times, we're not really showing any real fear at the current time. Then we have the latest reading of the National Financial Conditions Index. We're still below the black line. We get concerned if we go above that black line and we're actually declining below it. This is out of date now. This is the percentage of domestic banks that are they're starting to tighten their standards when they give out loans. We had this updated last week, and even this comes in at the 31st of July. So I think that this only updates every quarter, so we don't get this updated all that often, but it's showing that banks are getting a lot more strict. Then we have the real-time SOM recession rule, not updated from a week ago. We're barely above the black line. When we get concerned is if we go above the red line. And the same thing with the smooth U.S. recession probabilities. We're at the black line. We get concerned if we go to the red line. Then looking at the Brave Butters Kelly leading index, we are still going up just a little bit here, but we're not really spiking up. And this is getting a little out of date now as well. The latest reading from Inflation Nowcasting, we did have CPI come out this past week, and so there's been a slight adjustment in inflation going forward. Keeping an eye on the Fed. This is interesting. As of Friday's close, there's a 93.8% chance that when the Fed meets on November 1st, they're going to leave rates where they're at right now. And we're seeing that kind of getting more of a conviction, where the dark blue area, that's where we're at now. Then we have a day ago, a week ago, and a month ago. And you can see how the probabilities have really gone up that there's not going to be a rate increase at the next meeting. Keeping an eye on the Fed balance sheet, where it is declining and has been ever since June of 2022. We saw a little blip up here during the banking issue that we had last March, but then it is resuming its downtrend. So when we look at this on a year-over-year basis, the assets are continuing to drop off. Looking at the advanced decline line, where we're still above the moving average based on price, we're dropping below based on volume. So we're seeing a bit of a mixed picture here. Seeing a little bit of an improvement with the new highs versus the new lows. So it's turning back up, but we're still negative with our 4-week. We're turning up slightly with our 10-week average. The advanced decline ratio is still above 0, even though it did decline. That's still positive. Accumulation distribution showing some improvement and actually looking a little more positive on the daily chart. It's looking a little better here, but it hasn't quite crossed above the red moving average yet. Keeping an eye on our trend, where we are declining. The black line is the ADX. It's below its moving average. The red line is on top, although it's coming down. The green line is on bottom, even though it's coming up. So the market may be getting ready for some kind of an inflection point now. Keeping an eye on the Arun. The green line here, that's the buyers, and they are decreasing. We're also seeing a decrease in the sellers. So when you compare the two, we take the oscillator down here. When it's above 0, that's positive. And we're not seeing a really big change in that. We're still negative on the daily chart with this. The mass index is not generating a signal now. Looking at the daily chart, we're right on this long-term trend line here. And that's about as indecisive as you can be. If you look at the last number of bars on the bottom, we only had 1 or 2 days that were actually above average. Looking at our trend channel, I didn't extend this out on this chart, but we're a little bit above this. So we have more of a positive slant currently longer term. And then looking at the pivot points, where we're kind of in between any of the R levels or P levels right now. So when you look at the 50-period simple moving average, we continue to be in an uptrend and the red line is going up. That's positive. The long-term trend is still positive. The McClellan oscillators cross back above 0. That is positive. So we're seeing some improvement with the summation index based on price as well as volume, but both of these are still below 0. So that's still negative. The Swenlin trading oscillator based on price and volume are crossing back above 0. That's turning positive. The bullish percent index, it did drop down below 30 and now it crossed back above. That's a buy signal. Even though it's still below 50, this is a positive signal that we're seeing. The PMO study, we're still going down on a momentum basis. Now on the daily charts, all of our momentum oscillators have switched over positive now. We're on the weekly chart. They haven't calculated in here yet. So we're still going down with the PMO. We're below 0 based on price and volume, even though we saw a bit of a bounce. So with our PMO studies, the PMOs that are rising, pretty much flat, we are seeing the buy signal show some improvement. And after getting extreme negative, we're seeing a bit of a bounce with the PMOs that are above 0. The Bollinger Bands, looking at the percent B, we're below the midpoint, so that's negative, and we're not getting an extreme reading. Here's all of our weekly oscillators where we're down across the board currently. The Chaikin money flow also is turning negative, where we're turning more positive on the daily chart. So we're seeing some mixed signals there. The Chaikin oscillator, after getting extreme negative, is starting to bounce back up. We're actually positive with this on the daily chart. The force index is negative on both the daily chart and here, but we are showing some improvement. The money flow is just at the 50 level on the daily chart. We're slightly below 50 on the weekly chart. We're above the midpoint when we go back 1 week, because we've had 2 weeks in a row that were up, not by very much, but they were still positive. But when you look at the 50 period rate of change, or 50 weeks, we are showing a decline here. That's longer term negative. The RSI based on 14 periods is just barely above the 50 level. So that's pretty much non-committal right now. And the daily special K chart, it's right on top of its red line. It doesn't know what it wants to do right now. So if we go up, it could turn back positive. If we continue to fall, it will probably turn negative, where the weekly chart continues to be negative. Stochc RSI is extreme negative right now. And the Williams percent R, after being extreme negative, is showing some improvement. The ultimate oscillator still below 50 and was flat this past week, where it's turned positive on the daily chart. The vortex has switched over positive on the daily chart, but it's still negative here on the weekly chart. The Copic curve has generated a buy signal on the daily charts. It's still going down on the weekly chart, but we're still hanging in there as far as support. We're well above this 40 period moving average. Yeah, it'd be a lot more positive if we could get above the 10 period moving average, and these fib levels and long-term moving averages, we're still well above those levels. Our different charts, the Heiken Ashi, how's this for a non-committal? This is what we would call a doji, where it opens and closes right about at the same point, but we would still default to negative for right now since we have black candles. The Kegi is also negative since it's red, but it's pointing up. That's negative with a positive slant. The Renko chart has a red box, that's negative, and the 3-line break is also negative. The ease of movement, looking at the 14 period, we've turned positive on the daily chart. We're turning up, but we're still negative here on the weekly chart. We didn't have anything new that was generated on the point and figure chart. We didn't bounce enough in either direction for that to change. The Elder's impulse system for the S&P still remains negative with red bars. And we're negative with the parabolic SAR with the dots on top. We did cross over to positive on the daily charts. The PPO studies, we're declining in the long term. We're turning more negative in the intermediate term, where in the short term, we're showing some improvement and we're just barely positive. Some daily charts that you might find interesting if you don't watch the daily video, we've come right back up to this longer term trend line and we're closed right on top of it currently. The 50-day cycle, it turns out I calculated it wrong. I was 1 week off. Instead of the new cycle starting on October 11th, it now will start on October 17th in the upcoming week. Sometimes that can signal a change of trend. Sometimes it can mark a top, a bottom, or a continuation, and we don't really know what's going to happen with that. Keeping an eye on our daily short-term fib levels, we're right back down to this 100% retracement level, which this equates to the August 2022 high. Longer term, we're right down and just a little bit above the 61.8% retracement level with the longer term fib chart. Here's the daily special K chart where you have the black line right on top of the red line. Looking at the NASDAQ 100, we had come right back up to this previous all-time high, and we were above the 50-day moving average, but then we ended up closing down below that, but we're still above this pivot level. But on a momentum basis, we're still looking better with the PPO. We're below zero, but the black line is above its moving average. So that is showing some improvement currently. The FANG index closed right on its 50-day moving average. And the arithmetic scale going back to 2009, we're a little bit above it right now. So that gives us more of a positive slant. Looking at some other markets, we're seasonality. Looking at the S&P 500, we were down in September, 4.2%. And we tend to be up about 80% of the time with an average return of 3% in October, but there's still a lot of October left to go. This is the S&P, the mid caps and the small caps with no studies. If you really look at these, you'll see that we're seeing a little bit more weakness in the mid caps and a lot more weakness in the small caps. That's not necessarily healthy. But when you look at the Dow, even though we drop below the red moving average, we're still in an uptrend. The NASDAQ is still in an uptrend. The NASDAQ 100 is still in an uptrend. The mid caps rolling over, dropping below the moving average, and we haven't crossed over yet. So we're still in an uptrend. And the small caps, we're just about getting ready to see a death cross on this chart, where we've already seen a death cross on the daily chart. The NYSE, even though it's been showing some weakness, is still in an uptrend. All stocks, weakness, but an uptrend. Looking at the biggest software companies in the US, we're still below this red line, the longer moving average. If we bounce up out of this, we might avoid seeing a death cross here. The FANG index is still right on top of this longer term moving average, which equates to the 50-day moving average on the daily chart. ARC continues to be in an uptrend, but is below its longer moving average. Looking at the banks, we were starting to see some improvement here with this ETF, but we're declining and below 50 with the RSI, and the MACD, which had been positive, is now starting to roll over. Keeping an eye on all of the deposits, we're seeing some money going back into commercial banks. Looking at just a blanket chart of Dow, traditional Dow theory, we have the Dow on top. The transports have been really underperforming now, and that's been pressuring stocks as well, where utilities have just fallen off a cliff, but they did bounce in the previous week. And that was because interest rates are going down. As interest rates are going up, that will really hit utilities hard. Some other broad markets that we look at, the CRB index weekly chart, we're still in an uptrend. Oil, after getting up into the 95 range, dropped back down into the 80s. Well, we closed at 87.69. Copper is not quite at a death cross yet, where we are at a death cross on the daily chart. The dollar continues to do well, and that's been pressuring stocks. Gold is still in an uptrend here. We really dropped down, and then it came back up, and but we've already switched to a downtrend on the daily chart, and we've already switched to a downtrend on the daily chart of silver, and this is getting ready to show us a death cross. Looking at bonds, based on price, we are in a downtrend, so stocks are outperforming bonds on the monthly chart. We're still getting a negative result here when we take the 1-month yield and subtract the 3-month yield. That's the way it should be. Here's a daily chart of the rates showing how we've been going up overall. Here's a weekly chart looking internationally, where the US is now back in the lead with the highest interest rates, followed by the UK and German rates, where the Japanese rates have been going up, but they're quite a bit lower for a different reason that I'll talk about if it ever becomes relevant. Some relative studies looking at the intermarket analysis chart going back to the beginning of the year. We still have stocks in the lead, followed by oil, and then the dollar, and then gold, where as of the beginning of August, bond prices have gone negative. Looking back to the all-time high or the beginning of 2022, we have oil in the lead, followed by the dollar, gold, stocks, and bonds continue to be negative. The NASDAQ 100 to S&P 500 ratio shows that the NASDAQ 100 is outperforming. They still have been doing well, both of these indexes in 2023, but the NASDAQ 100 has been performing better, and that's the big mega caps. Well, those big mega cap stocks are also in the S&P 500. Looking at the S&P 100, which are the biggest stocks that make up the S&P 500, they're still hanging in there and doing well. This is where our strength is coming from, the big mega cap companies. Growth continues to outperform value. Gold is really underperforming the S&P, and gold is also really underperforming the dollar. Bonds continue to underperform stocks. Low volatility stocks still down around this area where we hit a bottom before. Are we going to be able to bounce up off of that, or are we going to continue lower, but they continue to underperform the S&P? Discretionary is still outperforming staples, and it's not like discretionary is doing all that great. It's that staples are doing really bad, and that's why this ratio is going up. Energy is bouncing back a bit, but in the longer term, it's still underperforming tech. Looking at some of our other studies, the NYSE Breadth Thrust, which was triggered almost a year ago now, that's still on the books. The ZWAG NYSE Breadth Thrust, where we had this triggered back in March, and we might, if we get some real positive action going, we might see another signal triggered, but it's going to have to happen pretty quick. And that's never happened before, so we'll have to see if it plays out that way this time. The Zohorchak method still is on a buy signal. That's positive. And longer term, going back to the 1987 crash, we're still a little bit below this longer term trend line. The log scale going back to 2017, we're still underneath this resistance level. When we look at the NASDAQ 100, we're still underneath this resistance level as offered by the trend line. The NASDAQ 100 to Dow ratio has not peaked out yet. We're waiting to see if that will happen. And when we look at the Qs and compare them to the small caps, the Qs are really outperforming, but we haven't quite reached back to this high level that we saw back in the 2000 spike. Some momentum studies. This is just a bigger, longer term look at the MACD chart where we continue to be negative longer term. We've switched over to positive on the daily chart. Then I finally received this from Tom Bowley. This is his research for October, where staples tend to not be hot and financials tend to be hot. We're coming into the middle part of October where sometimes we see a bounce, but then after that, we tend to see weakness before we see some strength going into the end of the month. We have asset managers and banks, which are two industry groups that tend to do well in the month of October. So this is based on the daily charts and it only applies to Monday's session. We're still dealing with the UAW strike. We still don't have a Speaker of the House. We still have the Israel, Hamas, Hezbollah, Iran war that's going on, and I'm not quite sure what to call that yet. The technicals on the daily chart were kind of in flux right now, but they are showing some improvement. And in the short term, we were turning more positive, but then we became overbought. And then Thursday and Friday, we saw things pull back. That's when I said, is the fizzle, is that going away? Are we starting to show some weakness, or are we going to be able to bounce back and regain some strength? We will get the Empire State Manufacturing on Monday, and then the whole list of geopolitical events. Right now, it's about Israel. Here is the calendar economically for the upcoming week, where we're going to get retail sales on Tuesday, but then a lot of it's going to be housing and real estate related. We will get LEI, the leading economic index, later in the week. Here is the Stock Traders Almanac statistics for October 16th, where we're neutral to positive across the board with the Dow, S&P, and NASDAQ. This is a seasonal chart that I've kind of tried to update here. We're more or less in this red box area where we still might have some weakness historically before we see a bounce coming up out of that. Here's another seasonality chart where we might see some weakness here before we see a bounce. Doesn't mean this is what's going to happen. This is just what has historically happened. We also have some Carson research looking at the box where we might be in that bounce time now before we tend to see some weakness. Looking at the pre-election years, when we're having a sitting president who's running for re-election, that's the green area here where we might be in the more positive time before we typically see some weakness. The NASDAQ also, a little bit of improvement and then weakness in the later part of the month. The S&P, strength, and then weakness into the latter part of October. Again, it doesn't mean this is what's going to happen. This is just what has already happened. Then when you go back to 1950, we have a slight edge being up more than down for the S&P 500 during a pre-election year. The scenarios that we're going with right now, we haven't turned over to the down scenario. If anything, we're still leaning to the upside, but that could change if we have a down day on Monday. We're not going with the sideways trend, and that could also change because both ADX charts could end up dropping below 20. So the warning signs, we tend to be better in October than we were in September, which is not hard to do. Our longer-term equity put call ratio is going up, and that's negative for the market. Or the 5-day moving average or equity put call ratio is also going up. This was just added to the list for Monday's session. It had been going down, which was positive. Now it's starting to turn back up. The risk on posture overall has been showing weakness, but it's really been chopping around lately. Our 50-period study of new highs, new lows, and then we take an exponential moving average of that, it is negative. We've dropped below zero. The Russell is below its 200-day simple moving average. On the daily chart, we're wondering, did that create a head and shoulders top? The small cap, which is another way of measuring the small stocks, it has generated a death cross. And then we have some long-term signals that I just go over in the weekly video. The longer-term trend lines that we were drawing there for the S&P and the NASDAQ 100, we're still underneath those levels. And then cumulative new highs, new lows for the NASDAQ, they've been showing this for a couple of years now, real weakness. And then the 3-month yield is still above where we were at back in 2007. We're waiting to see if that's going to roll over and start coming down. We don't know if that's going to happen now because we're seeing a real shift in the overall interest rate environment. And then we're dealing with earnings season, which can be either positive or negative. The positive things, the daily special K chart, which I showed you in this video, we don't know if that's going to remain positive or turn negative. Our oscillators on the daily chart, as well as the NASDAQ 100 and S&P 500 oscillators, they have all turned positive now. The parabolic SAR is positive. The BPI has also been generated a buy signal by crossing back above 30. The Copic curve is a buy signal. We have the Pring bottom fisher, which is crossed back over and generating a buy signal. The vortex has turned positive, and the Staples to S&P 500 ratio, as well as the S&P 500 to utilities ratio, both are supportive of the market going higher. The Russell and the mid-caps, they're below their 200-day moving averages. The longer they stay there, the more we might generate a death cross. Small and mid-cap growth continues to be positive. The financial sector is also below its 200-day moving average. It may generate a death cross soon. Positive signs longer term. We have seasonality and setups. That's the NYSE breadth thrust. That's the Zwig NYSE breadth thrust, the Zohorchak chart, and the different charts that I've been showing about that. The S&P is still above the downtrend channel upper line. I showed that chart in the deep dive video. So our conclusion, we're turning more positive, but that could really shift quickly in Monday's session if we see some weakness. This bounce that we've been seeing, is that just a short-term bounce, or is it going to develop into something longer term? In the short term, we're still working off a bit of being overbought. We pretty much have worked all of that off now. In the intermediate term, we are showing some improvement there, but it's just showing improvement and turning positive. It could switch back to negative with some follow-through selling, but we're still positive in the long term. Okay, so thank you. I really hope you found this helpful. Please feel free to check out the daily videos that I post. I will be posting an intermarket analysis video as well as the deep dive video. Have a great weekend. Even though the baseball playoffs are not making any sense this year, I hope your team is winning. And I will talk to you in the next video.